In 1950, a 19-year-old kid from Nebraska walked into a bookstore. He picked up a book that cost less than $5. That book didn't just change his life. It turned him into the greatest investor in human history. That kid was Warren Buffett. And that book is what we're breaking down today. The Intelligent Investor by Benjamin Graham. The book Buffett himself called, and I'm quoting him directly, the best book on investing ever written. And by the end of this video, you'll understand exactly why. Not just the concepts, but how to actually use them. Whether you have $500 or $500,000 to invest. Let's get into it. Before we start, let me ask you something. When you think about investing, what comes to mind? Charts? Crypto? Someone on TikTok telling you to buy a stock? Here's the problem with all of that. None of it is investing. It's speculation. And Benjamin Graham spent his entire life explaining the difference. Graham was a Columbia University professor. He survived 2 market crashes, 1929 and 1937. He lost everything once, and built it back twice. So when he talks about protecting your money, he's not theorizing. He's speaking from scars. The first and most important idea in this book: there are 2 types of people in the stock market: investors and speculators. And most people think they're investors. They're not. Graham defines an investor like this. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. 3 key words there: thorough analysis, safety, adequate return. A speculator, they buy a stock because it's going up, because their friend told them, because it's trending. They're not analyzing anything, they're gambling. Now here's the brutal truth. When the market is up, everyone feels like an investor. When the market crashes, you find out who was speculating. Graham's message: before you touch a single dollar, know which one you are. This is my favorite concept in the entire book. And once you understand it, you'll never look at the market the same way again. Graham asks you to imagine something. Imagine you own a small business with a partner. His name is Mr. Market. Every single day, Mr. Market knocks on your door, and he offers to either buy your share of the business or sell you his share. Here's the thing about Mr. Market, though. He is completely, absolutely, clinically irrational. Some days he's euphoric. The business is worth millions, he says. Other days, he's terrified. He'll sell you his share for almost nothing. Now, should you let his mood affect how you value the business? Of course not. The business hasn't changed. Only his emotions have. That's the stock market. Mr. Market is every investor who buys when prices are high out of greed and sells when prices are low out of fear. The intelligent investor? They use Mr. Market. When he's terrified and selling cheap, they buy. When he's euphoric and overpaying, they sell. They are never controlled by the market. They control their response to it. 3 words. The foundation of everything in this book. Margin. The. Margin. Wan. Safety. Here's what it means in plain English. Never pay full price for anything, ever. Think about it like buying a car. The car is worth $10,000. You offer $6,000. If you're wrong about its value, you still didn't overpay. That gap between $10,000 and $6,000, that's your margin of safety. Graham applied this to stocks. Find a company worth $100 per share. Only buy it when it's trading at $60 or $70. Why does this matter? Because you will make mistakes. Every investor does. Graham knew this. Buffett knows this. The margin of safety is your protection against being wrong. The margin of safety is always dependent on the price paid. It will be large at one price, small at some higher price, non-existent at some still higher price. In other words, there's no such thing as a good company at any price. There are only good companies at the right price. Graham says there are two types of intelligent investors. The defensive investor. This is someone who wants solid returns without spending hours analyzing stocks. Graham's advice? Simple. Put 50% in bonds, 50% in a diversified portfolio of large, stable companies. Rebalance once a year. Don't touch it. Don't react to the news. The enterprising investor. This person is willing to put in real time and research. They look for undervalued companies, stocks trading below their true worth. They go deeper. They read financial statements. They think long-term. Here's Graham's crucial point. The enterprising investor doesn't just take more risk. They do more work. If you're not willing to do the work, be defensive. Stay simple. Don't try to be enterprising and end up being reckless. This might be the most counterintuitive thing Graham ever said. Most people treat the stock market as if it knows something. Stock goes up. The company must be doing well. Stock goes down. Something must be wrong. Graham says, no, the market is a voting machine in the short run. People vote based on emotion, trends, headlines, fear. But in the long run, the market is a weighing machine. Eventually, it measures real value, real earnings, real assets. So what does this mean for you practically? Stop watching stock prices daily. The price is not the value. They are different things. Your job is to understand the value and wait for the price to catch up. Let me leave you with this. Benjamin Graham lost everything in the 1929 crash. He could have quit. He could have blamed the market. Instead, he spent the next 20 years figuring out why YI. And what he discovered wasn't a secret formula. It wasn't a trading algorithm or a hot stock tip. It was something far simpler. Discipline, patience, rationality. Buy below value. Build in safety. Ignore the noise. The market will always try to pull you toward panic or greed. The intelligent investor? They don't follow the crowd. They follow the numbers. If this video gave you one new idea, drop it in the comments. I read every single one. And if you want the next book breakdown, subscribe. I put out one of these every week. No fluff, just the ideas that matter. See ya in the next one.